Good morning. Welcome to Trading Hour. I'm Sonal Bhutra. With me is Hormaz Patakia. Hormaz, good morning. Well, you know, we touched that 26,000 mark yesterday finally, but we've come off from those levels. We did that yesterday itself. But yes, that level has been reached too. And for now, the Nifty is absolutely choppy. This is something that we were expecting as well, even though Dow and S&P again touched record highs, Nvidia up 4%. So a lot happened in the global markets, but the GIFT Nifty was indicating that maybe the start could be muted, and that's exactly what has happened. 24 points lower on the Nifty right now. The broader markets, they are the ones which have come in for some profit booking. So that index is down around 371 points. Like yesterday, where we did see the advance decline ratio being absolutely equal, today there are more declines than advances in the markets. The CPSE index is doing well. The banks are in the green as well. Metals did really well yesterday. They have added on to those gains, but not as much as we saw yesterday. So yes, a lot of moving parts, but Nifty choppy today.
Taking a bit of a break, right?
Yeah.
And usually is the case after a major landmark. We finally managed to get to 26,000. Now, okay, fine, let's take some profits off the table and then consolidate for a bit, then move higher. That has been, and today also, of course, it's the expiry for the Nifty Bank as well. So you keep that in mind for the second half of the trading session. But for now, the Nifty remaining around those levels of 25,900. The Nifty Bank too, just about the flat line around levels of 54,000 is where the Nifty Bank is. That has been the index to watch out for over the last 10 sessions, will be the index to watch out for in today's session as well. What's leading the downside though, as Sonal was highlighting, there is some bit of profit booking coming in for the broader markets. The PSU banks, sometime during last week, during Thursday or Friday, the PSU bank index was the top performing sector, but it's now seeing some bit of profit booking. It was down yesterday, down today as well. The top sectoral loser over 1% down. FMCG index is down 1% as well, courtesy the downgrade that has come from Dabur from UBS. So FMCG and PSU banks are leading the losses. But yes, the benchmark indices remain choppy, but some pain in the broader markets.
Yes, some pain in the broader markets, and that is something which was expected to continue for a bit, but we'll see which way things go for the markets. But we have to talk about market fundamentals. Joining us now is Prashant Paroda, Portfolio Manager of Allspring Global Investments. We're going to talk about global markets, Indian markets, and a lot more. Prashant, good morning. Thank you so much for joining us today.
Good morning. Thanks for having me.
You know, there's so much happening in the markets. If we talk about the global front, we do have the Fed rate cut that just happened. We do have the US elections coming by as well, and markets at new record highs when it comes to India as well. Just speaking about India, you tend to be bullish on India on the longer term. But for now, do you think valuations are stretched? And in the EM basket, where does India stand for you?
So, you know, we have several products. You know, we kind of market neutral in the all cap product, but in the small mid cap, we are overweight India, and we think, you know, the rally still has a lot more legs. You know, I think a lot of people have missed the rally from a global perspective is because they look at hindsight valuations. But if you look at the earnings growth trajectory of a lot of these companies, you know, you don't find that everywhere across the globe. And the beauty of the Indian market is, you know, they're defensive plays too. So even if the market corrects, if you pivot to the defensive plays, you can still generate alpha. So it's not just you just buying banks, infrastructure plays. You have IT companies, you have pharma, you have healthcare. So the diversity and the breadth of the market, I think there's no market like this in emerging market space. And that's why we think, you know, alpha generation, India is the place to be from near-term and a long-term basis as well.
No, Prashant, good morning. Thank you for joining in. We're going to talk about flows now, the foreign investors. There's been some bit of inflow that has come in after the Fed cut its rates. But when you talk to a lot of global analysts, they mention that valuations remain a concern for a lot of these FPIs who are sitting on the sidelines with cash. They want to wait for a 5-10% correction before they deploy their cash in. What is the conversation that you are having with your clients? Is valuation a deterrent for FIIs to pour in more money? And if the Fed continues to cut rates, will that lead to more inflows as well?
Yeah, I think the Fed cutting rates is just going to be the booster shot for emerging markets. And, you know, yesterday we saw China rally as well. So a lot of people think it's an either or, but I think China rallying is great for the asset class as well because India is put in a bucket. So if India is doing well, China is not doing well, overall returns aren't that great. And then people don't notice that bucket. But when every other country also starts performing, and India has done the heavy lifting this year, I think everybody notices the asset class. So from an allocator's perspective, this is great. The caveat just is, U.S. elections coming through and what it will do to trade. So if, there are two compelling thoughts. There are two candidates. One candidate, Trump, is hell-bent on opening the trade issues again. The other candidate, she's going to be more strategic, at least for now, on trade issues. So I think a lot boils down to what the geopolitics looks like on November 5th, and that is probably going to be a key concern for allocators to see how it will play out from that perspective.
So, of course, the tariff hike that could come by, and of course, China has been playing a very important role when it comes to no demand in their own country, so dumping goods outside their country. Prashant, in that case, you said there's still some legs to this rally that we'll see in select pockets. Where are you putting in your money in India? Is there something where you still see valuations are reasonable? Because you have to say valuations are stretched in the country right now.
Yes, from a historic perspective, they are stretched. But, there are still pockets, we think, whether healthcare or pharma, more defensive play, you can still, see earnings growth and you can project that, 2 or 3 years out. So you're paying a higher multiple than before, but as long as there's earnings growth, I think the stocks will still perform. So I think from our perspective, we just look from a bottoms up where the earnings growth will be. And, sometimes markets gives you opportunities where they think something is cyclical and market thinks it's structural. So we take that opportunity to get liquidity on those names. And the idea is to just reposition the portfolio where the earnings growth will be from our perspective.
Is there a pocket like that which the street currently believes is structural but you think is cyclical?
No, I think, my sense is at least a lot of the infra names have run up, but one thing you have to understand is that post the elections, there is more of a pivot to the social side of things, right? And, there was a scheme in Madhya Pradesh that got a lot of seats for the ruling party. That scheme is going to be deployed in Maharashtra. And my sense is if that's a successful scheme, it could be deployed throughout India. So you have to think about what it will do to government budgets and how it will constrain on the investment side. Because so far the government has done all the heavy lifting. Like, you can't blame the government for anything. They've done their job. It's for the private sector capex to sort of pick up for real estate. And a lot of that is moving in the right direction as well. But if for some reason the government year-on-year growth slows in a certain bucket and grows in the other bucket, then you have to kind of reposition your portfolio for that.
Okay. The other thing that's happening now is that big IPO rush that the markets are seeing. It's incessant. We do have approvals coming for 2 big IPOs again, Hyundai and Swiggy as well. What are you making of this rush in the markets? Anything that you've liked from the recent listings, any space? Yeah. And the 2 that are coming now, do you think those are exciting as well?
Yeah, I think, people always tell me, oh, there's all this liquidity rush, but, there's sellers too, right? So the market will work. Like, you'll find sellers, people will sell, promoters will sell, and you'll find, and I think it's very good. Like, if you look at Hyundai, the IPO that's happening, where their shares trade in Korea versus what they'll trade here will be a marked difference, because they'll be comped to whatever Maruti is, at some valuation around that. But I think it's good for India, because India gets to see the growth in Hyundai India, right? So, and they've been a dominant, second player in the market for so long. So I think it's great that all these new companies are coming into India, and investors will get opportunity to take advantage of that growth. You know, someone might not like the global play, might like just the India play. So the India play would trade much higher than, you know, the global plays.
The IPO rush is all set to continue, I guess. But Prashant, thanks a lot for sparing time and joining us today to share your views on the markets and on the sectors that you prefer as well. Thank you so much for sparing time.
Thank you for having me.
And that was Prashant Baroda there of All Springs Global Investments. Time for a short break. Up next, we talk all things commodities. Manisha Gupta joins us on the other side. Stay tuned. Welcome back to Trading Hour, and Manisha Gupta now joins in to talk about all things commodities. Manisha, good morning. What's on your radar today?
Well, I'm looking at overall commodities right now, Hormuz, because there's a strong momentum here and the price gains have extended in the day-to-day as well. Well, we have seen the dollar index decline to a 14-month lows. Most of the high-yielding currencies are trading higher because the commodity currencies also are trading higher, and that is what really seems to be taking an impact. Also, the kind of statements that we've been hearing from China for the last 2 or 3 days have been having its sentiment impact. China, to begin with, has cut in its 7-day reverse repo. A reduction in RRR to inject nearly 1 trillion Chinese yuan is what they have done, and then there is also a refinancing of 37 trillion Chinese yuan for mortgage of various sectors there. Also, China has lowered today MLF by nearly 30 basis points to 2%, and the China governor has said that they are going to be looking at cutting RRR to by 50 basis points. When that is going to be done, that timeline hasn't come, but that sentiment clearly shows in case of prices is the reason you're looking at copper prices trading at a 2-month highs, aluminum at 3-month highs. You have zinc prices trading at a 4-month highs right now. We do know that gold is trading at all-time highs. In the overnight markets, we've seen silver prices gain up by 5% as well. Platinum gained up by 3% into the markets there. And then you have also the crude oil prices, which also are trading at around 1-month highs, 1.5% on gains onto this one as well. And $75 seems to be holding. So everything in case of commodities is doing well. And then to add to that, the markets will wait for the retail sales data, PCE numbers, jobless weekly jobless numbers from US. All of that comes in the next couple of days. And that is where the next direction would come in from.
It's all about commodities today, right? You pick one up and you'll see it surging. Thank you so much, Manisha, for joining us with all those important details. The commodity markets definitely on our radar today. We'll do one thing. We'll slip into a short break. When we come back, we'll discuss market technicals with Mitesh Thakkar, also discuss his top trading bets. Welcome back. You're still tuned into Trading Hour. Choppy markets today, so it's a good time to get a technical check on the markets. Mitesh Thakkar is joining us for that. Mitesh, good morning. Thank you so much for joining in. What are the charts suggesting now? Some up move from these levels, or will remain range bound for a while?
So my sense is that I think, there could be some consolidation in the indices given the fact that we've had a good run. And earlier in the day, I talked about, waiting for the dip if you want to enter afresh, because we've had a good run. We've hit an important level on the Nifty. The 26,000 is a round number, as well as there's good call open interest there. And also is the fact that, we are overbought with the rally which we've had. So I think a similar scenario is playing out on both the indices. So maybe you will have a quieter day today. And towards the end of the expiry, which is when the bank Nifty expiry comes into play, maybe you'll see some movement. But overall, broad bias is on the long side. I'm still positive on metal and a couple of banking names. So I have a buy on Vedanta. Keep a stop below levels of 469 here. Look for targets of 495 on the upside. And on the selling side is Bata with a stop at about 1435 for targets of roughly around 1380.
Mitesh, good morning. What would be that suitable level then that you were mentioning, a suitable dip to enter? What would that level be?
So on the Nifty morning hormones, the level which I'm watching is closer to about 25, 830, 850 as the support area. So around 25, 880, 890 zone, you can take a long position with a 60 odd point kind of a stop loss.
All right, Mitesh, thanks a lot for joining in, sharing with us your views on the index as well as specific stocks as well. Time for a short break. Get you more on the markets on the other side. Stay tuned. We'll be right back. Back with us here on Trading Hour. The markets are exactly where they were when we began the show. The Nifty is still around those 25,900 levels. The Midcap index trading around 0.5% lower. The FMCG index, though, has extended its losses now down over 1%. At the lowest point of the day, the Midcap index seeing some bit of recovery from the lows of the day. But the PSU Bank index and the FMCG index both are adding to their losses so far. Among specific stocks, Power Grid is the top gainer on the Nifty, and that is also because of the national electricity policy, and of course also it's find some mention among one of the 20 buy recommendations in Goldman Sachs' India strategy. So Power Grid, the top Nifty gainer, currently 3% higher. But the broader markets seeing some bit of pressure, Sonal, but the benchmark indices remain where they are.
Yes, and as Mitesh also said, he expects some consolidation to come by, right? Because we've already run up so much. So this is something which would be par for the course. We do have a lot of movers. Z Entertainment, for instance, that stock has moved to the day's high, up around 5%. And SH Kelkar, after yesterday's move, is adding on to those gains, up another 5% on SH Kelkar right now. But that is about the secondary market. We have a lot of action in the primary market as well. Big IPOs set to hit D Street. Market regulator SEBI has cleared Swiggy's confidential IPO filing. Auto major Hyundai could be set to list by Diwali in India's biggest ever IPO. As sources tells Money Control that SEBI has cleared plans for a $3 billion listing. Vinny is here to give us more details on this. Vinny.
Yes, so in terms of two big IPOs that we should be keeping an eye out, Hyundai Motor India, that is finally cleared for IPO. The SEBI has given an approval last evening, and the company is planning to raise around $3 billion via IPO. It's going to be an OFS where Hyundai Motor Corporation, that's the parent company, will be selling around 17.5% stake. So it's a completely OFS. There is no fresh issue that is happening for Hyundai IPO as of now, is what we understand. Now, obviously, this is the second largest IPO that we are watching out for in India. The first one was LIC, and now this is bigger than that as well. So yes, keep an eye out on that, because Hyundai Motor is the second largest passenger vehicle OEM in India, 14.6% market share they have just in the domestic market, plus globally in terms of exports also. They are their second largest in terms of exporters for PV from India as well. So keeping an eye out on that. Margins also better than its peers. So whether you compare it to a Maruti, Tata Motors, M&M's auto segment, the EBITDA margins for 9-month FY24 has been much better. So an interesting one there. Swiggy also has got the green light from SEBI in terms of the approval for the IPO, the confidential IPO which they filed for. Proposal is for around $1.25 billion, I beg your pardon, is what Swiggy will be raising. In that, $450 million is expected to be fresh issue, while $800 million is expected to be OFS that we're watching out for. So yes, keeping an eye out on that. We have Porses, who's holding 33% stake, is likely to be selling some part of their stake, as well as SoftBank is among the name of the OFS sellers. So keep an eye out on these two interesting IPOs.
Very interesting IPOs indeed. Vinny, thanks a lot for that. Big ones set to hit the primary markets. But Piramal Pharma is the other stock that is on our radar today, and that stock is trading with gains of up to 5%. Now, the company is saying that its estimate to be a global pharma, health and wellness company. Ekta is joining in with more details. Ekta, what were some of the key takeaways from their investor day?
Well, a couple of important takeaways from the investor day is that the estimate to be around $2 billion in terms of revenues with 25% EBITDA margins by 2030. Now, in terms of a breakup, the CDMO business is estimated to be around $1.2 billion in terms of revenue with 25% margins. Complex hospital generics, estimates of around $600 million in revenue with 25% margins. Consumer healthcare, around $200 million is what they're targeting in terms of revenue with double-digit EBITDA margins. They aim to reduce their leverage to 1 times net debt to EBITDA by 2030, and they're targeting high teens ROCE by 2030 as well. Remember that the company has made around 15 plus acquisitions in the past 10 years and had 350 plus regulatory inspections which have been successful since FY12. Now, a couple of analysts have written on it. Elara has said that the goal translates to about 3,900 crores EBITDA in FY30. They estimate equity value of around 54,600 crores by the end of FY29. The equity value is around 15% annualized return from current levels. The implied top line CAGR is only about 13%, which is quite achievable according to them. The implied EBITDA margin expansion of 900 basis points is, however, a tough task according to them. Margin improvement along with targeted improvement in ROCE could be challenging for the management.
Okay, so the stock is reacting to that commentary, and of course we'll be talking to the management of Piramal Pharma very soon as well. So stay tuned for that conversation. Thank you, Ekta, for joining in with all those details. Time for a short break. An exclusive conversation with Manish Chokhani of Inam Holdings coming up on the other side.
Hello and welcome to this special edition of Market Masters. We are in a bull market unlike any other. Comparing the current bull market to the previous one, which is between 2003 and 2007, now actually seems a bit underwhelming, isn't it? This one feels so much bigger, more broader and wider as well. And we're doing all of this with little help from foreigners. My guest today is someone who I think is one of the best articulators, thinkers about what is going on and where we are headed. I have with me Manish Chokhani of Inam. Manish, great to have you with us here on the program. Thank you very much.
Been a long time. Thanks for having me.
Thanks very much. Now, I mean, $4 billion a month mutual funds are getting. It's a flood out there. You know, and by the way, it's increased. Pre-elections, pre-June elections, we were getting about $2 billion. It's now $4 billion a month. I mean, you would have thought numbers would go down. It's actually increased. Where are we headed? With the flow picture first.
So, before the flow, I just want to take one step back. That as Indians, I'm just so happy that the kind of wealth creation which has happened in our country is unprecedented. And as you said, comparing it to 2 decades ago, while the percentage returns may look similar, the absolute amounts, remember we are at a $5 trillion market cap. And 85% of it is owned by Indians. There's only 15% foreign ownership. So the absolute amount of wealth creation which has happened in this bull run is just unbelievable. And hopefully it's a start of a virtuous cycle where you make the money, you reinvest it, you create more jobs and employment, you create more profits, and the cycle continues. So fingers crossed this continues. And like I said, the asset allocation mix of Indians, which we've been waiting for a long time to shift towards equity away from hard assets, is only just beginning. We are just 6 or 7% of assets are in equities. The bulk of it is still real estate and gold.
When this began, you know, people could have argued that maybe this is a bull market phenomenon because people are chasing things, they're seeing other people make money. But this is now continued and it's actually becoming bigger.
When you see it continuing in, you know, even through the drawdowns which have occurred, and this year we've had 2 or 3 major reasons for people to pull back. And this advent of SIPs, which the mutual fund has done an outstanding job, the whole industry, of getting people into the markets and not getting scared away at every downturn, I think is great. And remember, for context, if you remove the promoter holding, which includes the government and the 40% Indian ownership, remove the foreigners, the value of stocks with Indian investors per se is still less than the value of gold they're holding. And it's far below the value of the real estate they're holding. So it's easy to get scared away, but over the last 20 years, we never got scared that, oh my God, people might start selling gold because price is going up. And gold itself has been in a bull market during this entire episode and almost tracked the same returns as the index.
So you think this can continue? This will continue, or at some point it slacks off? What's your sense?
See, liquidity melt up. Remember we spoke last Diwali where I said in every decade since we broke this Bretton Woods gold standard and went to this dollar peg, we created bubbles in every decade. So in the 70s, it went to, you know, all the Nifty 50 stocks of the US. And of course, it culminated in the blowout of oil and gold and silver in that decade. Then it went to the emerging markets, which then was Japan and Taiwan in the 80s, and completely blew off. In the 90s, it culminated in the NASDAQ bubble. In the 2000 to 2010, it came to BRICS, in which China was really the center of the bubble and commodities. And the last decade then went to TMT and the Magnificent Seven, which have got extended due to this excess money printing through COVID and so on. So for me, it looked like in context of history and market cycles that India would be the epicenter of the next bubble. And the conditions were ripe because the country is reaching a critical takeoff point. The economy is reasonably well governed. The entrepreneurship has been unleashed. The reforms are good. Infrastructure is getting built, both physical and digital. So, and this move that the youngsters were happier to take risk in financial assets as opposed to hard assets. So the culmination of all that still looks like we are still heading for a big melt-up. And I don't think it's over yet.
Where are we in that melt-up period?
If I knew that, I would be Warren Buffett, right? So that's $1 million answer.
But halfway through, early on...
No, look, I've been underwhelmed, to be honest, by the amount of foreign inflows.
Right.
Like this year, I think we have, 15, 16 billion over a calendar. The last 12 months, maybe it's 20 billion. But 20 billion has come only through the JP Morgan
So this
debt
year in
indices.
2024, FIs have put in about $7 billion
Which is
to
nothing.
work.
Yeah.
Locals have put in 39, I think, almost $40 billion.
Right. So that's what I'm saying. The foreigners, I think, a couple of reasons, and this is just post-facto justification, because I would have expected a lot more to come in. That number one, you're making a lot of money in your home market in US.
Yeah.
And if US is 65% of the world, and remember, it's a $65 trillion market. And if India, even after the MSCI rebalancing is reaching 3%, and the global funds don't, frankly, look at India, and they will start looking at now. But let's say you get the 3% market wrong, and it goes up a lot. You basically drag off 1%. But you're making like a couple of percentage on NVIDIA every week over there. So I think that's one reason. The other side of the world, which is Japan, Europe, they are basically dead. So it's the flip of that is happening, that when you're dying in your home market, you're not really looking to invest abroad. So A, that has to happen. And it's also, I think, a reason why FDI flows have been relatively subdued, so on both fronts. Although debt flows, which we expected with the JP Morgan index inclusion and then the others to follow, those flows have started coming. So I would still expect it's not even like the first inning in a baseball game analogy of the foreign inflows into India. And the domestic flows, remember, if they keep lifting this market, they've so far only lifted what I say quadrant 4. Quadrant 1, 2 and 3, which are really the large caps, which is where the bulk of the money of the market is, hasn't yet seen massive flows. And eventually every fund manager in the world, hand on heart, is a momentum chaser. So if this market keeps performing for long, they're going to be here. Because if it were only valuations, as they all claim, then everyone would have been buying China, which is the cheapest market in the world. So I think it's a story which is unfolding. And maybe they come in through primary issuances, where again, we've not had the big companies coming with big issuances, neither from the government nor from the top 10 business houses. And that becomes then an entry point to start sucking in these flows.
Actually, I was at the JP Morgan conference yesterday, and they were telling me that there are lots of investors from mainland China there.
Interesting.
Interesting. So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
I mean it makes a major long-term top, which is not a great thing. So I mean, it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up, where the entire market goes up 10x in a decade. And then you don't see that prices for maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or
They've
someone
tapped
has
for
come
the new businesses
with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling. We've seen PE selling. We've seen MNC strategic selling. And it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we are a long way off from that climax. Or
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. All right. Manish, we're going to take a quick commercial break here. Stay with us. We're in conversation with Manish Chokani of Enam. Welcome back to the special edition of Market Masters. We are sitting down with the one and only Manish Chokani of Enam. Pullbacks are a regular feature of a bull market. It's just that this one has been without pullbacks.
Yeah, see, the fun and games actually this time has not been in... so again, let me step back. The top 11 companies are 25% of India. And average market cap there is in excess of $100 billion. And I'm just taking the NSE 500 at, let's say, $4.8 trillion. Of that, 25% is $1.2 trillion, which is 11 companies. So that's $110 billion average. Nothing's happening there. The next quadrant, which is from 1.2 to $2.4 trillion, has another, I think, 31 companies, which gives you that average as well over there. Again, nothing. So the top 40 companies are half of India, and which is where the bulk of the foreigners were invested, and these stocks haven't actually really done very well. Right. And when we talk financials or Reliance or whatever, they've given decent returns, but it's underperforming. Quadrant 3 is, I think, another 80, 90 companies. So 130 companies are 75% of India's over. It's harder to lift these companies because these are in the categorization of large caps, which is over a 50,000 crore market cap.
And these 130, 140 companies, about $3.5 trillion in market capital.
75% of 5 trillion, whatever it is. So that you pretty much nothing has happened. And this is where the coverage universe of the brokerages used to be. This is where the FIs used to invest. This is where the mutual funds buy. By definition, they are large cap. All these are over 50,000 crores. The whole action has been happening in whatever the balance 370 companies, which is in quadrant 4. But it's $1.2 trillion. It's still a staggering amount. And therefore, the domestic wealth creation, like I can talk of it as if it's small, but it's thousands of crores of profits being made by investors, and people who thought their companies are worth 2,000 crores are seeing them at 20,000 crores now. Because everyone's trying to lift it up and get it into a mid-cap index or get it into the small-cap index and so on. The worry to me is that end of the market is trading at twice the multiple of the market. Now, historically, yes, a smaller company can grow faster, and we ourselves made all our money in, the first era was all the Infosys and ZTVs and Maricos, which were compounding like crazy in the 90s. But very small percentage of those companies, as I just explained, will make it from that 387 list to the 30 list or to the 11 list. So the stock picking which you do there is important, because if you get that wrong, God help you. And I'll give you the most famous example of the best company in India, I can argue, is Infosys. It made a dramatic top in March of 2000. It was a $46 billion market cap back then. It basically doubled in 24 years, which is, nothing wrong, but 20-year double is, drastic underperformance for a fantastic company. Company did everything right.
From the top of 2000 over the next 20 years,
46 billion to it's probably, 93, 94 billion today. The market is up from 6,000 to close to 90,000 or 84,000, let's just say. So it's what, 14 times up. The market is 14 times up. Forget what's happened to other companies. Whereas the best company probably only doubled. And of course, I'm excluding dividends and buyback, but add a few percentage points there. But it's not that dramatic. So when you get pricing wrong in a small cap, heaven help you. And why small cap? Even from the top of 2007, when Reliance kind of went to sleep then for the next 12, 13 years, you didn't make any return. Then it quadrupled during COVID when they did the Facebook placement and so on. And I think that's really the central risk in our market, that small caps and this SMID exchange, my God, it's I think some of the indexes up 80 times in the last 3 or 4 years. What's going on there is far, far bigger than the whole worries we have on FNO. FNO is a $4-5 billion problem in a sense of the losses being made. It's not insubstantial, but in the context of what's going to happen, maybe in this quadrant 4 of the market, as I call it, and this whole SME exchange, that's going to be painful.
That quadrant
losses.
4 includes the SME?
No.
That's separate.
That's
right?
tiny, I mean, a 12 crore issue attracts 5,000 crores of investments. Something funny is going on. And I'm not casting aspersions on the companies or the people, but I mean, who's putting 4,800 crore applications into a 12 crore issue? So something's going on, God knows. So those are the things you worry about.
Okay.
But having said that, the broader market, when I say the top 30, 40 companies, usually if something goes wrong there, that's when the market collapses. Or supply from there will overwhelm the market. But it can't be a quadrant 4 problem which blows up the market.
But you're saying that in quadrant 4,
right,
there's a problem in the sense
the valuations are berserk over there. I mean, again, great companies, but and again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example. Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then, because it'll be a fairly large company. So it needs a $4 billion PAT, profit after tax. To get to a $4 billion PAT, just for context, today TCS with 6 lakh employees makes $6 billion. So is this possible? How will they do it? Will they add more lines? I mean, Amazons of the world have done it. They started somewhere and they ended elsewhere. But if you're taking that bet, your time horizon has to be that, or your return expectation has to be that much lower. And that's the sort of stuff going on over here.
Got that. I want to talk about leadership in this bull market as well. And we'll get back to what to do and advice for investors a little later. So PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done? Or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically, these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after, again, the last cycle. The flip of it, to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies. But it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
So things like that tend to happen. I can't forecast what will happen in.
But you're very bullish on the financialization theme.
I am very bullish.
And financials, right? I mean, advice for investors who are watching, Manish. I mean, because in many ways you're saying that a lot has happened, so one must be cognizant of that when you make fresh purchases.
So what happens, and again, it's something I've experienced in the past, so maybe that would be of benefit to investors, is, look, the market tends to be a 75% large cap, 20% mid cap, 5% small cap type market, and that's the distribution. Few of these will graduate to box 2 and few of these will graduate to box 1. So your normal portfolio allocation tended to be a 80-20 mix, that we would keep 80% large cap for safety and 20% to give you the alpha, to give you much better. Given that we guys also came back from, we built a lot of our wealth on the small and mid caps only. But when you start doing that, you realize your portfolio mix tilts because those companies become reverse. The small and mid become 80% of the portfolio and the large become 20. And whenever something goes wrong, like you had crises in 2008, 2018 even, for no fathomable reason, they can tend to fall 60 to 80%. And that is very, very damaging for the portfolio, and that is what really scares you out of the market. Like, again, the same famous example of Infosys. It went from 16,000 to 2,700, which is like almost more than an 80% fall in a high-quality company. Because when that happens, liquidity, you'll be surprised, it just vanishes in the stock and you just can't get out. And what you think my portfolio value is, whatever, 100 rupees, it looks like it's less than 50 suddenly. So if you can just keep tilting your portfolio, that if your asset allocation is okay, that you may have maybe 50, 60, 70% of your money in equities. It's very easy right now to feel you're making so much money, get out of banks, liquidity or whatever, put it all in the market. If you're not prepared for a downturn in the market, then you'll get scared out. So asset allocation to equities, number one. Within that, what is your mix in your portfolio? Be very cognizant. Too much concentration in a small or mid category or too much concentration in one sector. Again, for example, the parallel of TMT in the 2000s. If TMT became 50, 60% of your allocation and that fell by 50, 60%, where were you? So just be cognizant of portfolio balances. I'm not suggesting this is better or that is better, but just do what's right for you and what stage of life you are at. So I'm finding people who are 60, 70. I have a cousin who's 74 years old in another city, and she's calling up and she wants to buy small caps. She wants to buy like the 3 most powerful, high volume stocks in India nowadays with 60 lakh shareholders, or is it 60 lakh or 60 million? I don't know. Yes Bank, Idea, and Suzlon. I mean, maybe it's great companies and they have a view on it. But, I mean, is it the right stock for you? First, you think about that. People will call up and, if they'll ask me, should I buy a bank? And if I end up saying ICICI or HDFC, they're like, but this bank goes up every week. Again, nothing wrong with it. But is that right for you? So just think of allocation in your portfolio and what you're doing.
And the other point I think which you made before as well, riding existing winners is one thing. Going into new
absolutely
things,
right. So when you're in the middle of a cycle, most horses are going to run. Don't be impatient if in this cycle, this horse handles run. For example, if, let's say, financials haven't run and you feel, oh my God, defense and railway is running, and you leave this and you come to this horse and this horse is already run and it's ready for a down drift or a sideways move. And you've jumped here and you know less about this than you knew about that. It's going to be damaging again if something wrong happens over there. So I think just stay away from what I call FOMO. This is not a FOMO moment in life. Don't get greedy. Returns have been extraordinary and there's no reason India won't. I still think 90% of our wealth lies ahead of us in the next 20 years. If we do 4 times in 10 years and we again repeat the 4 times in the next 10, it's 16 times. Even if we don't do 16, we go 10x from here. You really have to have patience over here. That's all. You get the right companies. If they're around 20 years from now, believe me, you'll be really wealthy.
So it's not a sprint from here.
It's not a sprint. Don't
we've
try
had
to
a
keep
sprint,
jumping.
but it's not a sprint.
I mean, it's like in an era of T20, I'm advising play like a test cricketer.
But because you have played T20 already. I mean, most have played the T20 game. Now it becomes more of a test match. Right.
So I think just be a bit relaxed. I think the country's future is bright. The entrepreneurship is still very much there. The potential for growth over here is still very much there. When I look around the world, they're all ex-growth, highly indebted, waiting to blow up. So the opportunity is here, but just don't blow yourself up in the process.
You've got to stay in the game. You've got to be around, essentially.
Like Buffett used to say, 2 rules of investing. Rule number 1, don't lose money. Rule number 2 is don't forget rule number 1. I think that's all you can do.
That's such a wonderful way to wrap up this conversation, Manish. Thank you so much for dropping by, and thank you for sharing all that wisdom with us.
Thanks for having me.
Thank you.